Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. We are going to do a subscriber request today. Jacob Donkey Butt 10 commented, could you do a video on Bristol Myers 3 days ago? This is on the 4 stocks I'm buying in June video, so go ahead and tune into that one if you haven't checked it out yet. We are going to take a look at Bristol Myers Squibb and stay in the healthcare sector. We looked at a healthcare sector company yesterday, and we'll stay in that sector. It is June 4th, Tuesday. Let's jump right in. And before we get too far into the video, if you could do me a favor and hit that thumbs up button down below if you find any value in the content. Make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that subscribe button down below. Make sure you ring that notification bell so you're notified whenever we put out any new content. And drop a comment down below if you'd like me to cover a stock pick for you. Companies, like I said, this is a subscriber request. I do subscriber requests. So if you have a company you'd like me to cover in the stock pick of the day series, drop it in the comment section down below and I'll work it in on a day that it pulls back. Really do appreciate everyone who's taking the time to do that, and really do appreciate everyone who's taking the time to subscribe to the channel. And I am getting a lot more comments that people are finding these videos, people are sharing these videos. So again, thank you to all of you out there who are sharing the videos and with your friends and family out there. Really do appreciate that as well. Now, this is the Vested Interest Stock Screener. This is how I set up the videos. It's also how I look at a company on a high level to see if I'm interested in investing. Just because it meets 5 of 8, if it's a bank, I add in price to book, and it must meet 6 of 9. And then if it does meet that criteria, it goes onto my watch list. I do more of a deep dive into the company, look at the revenue, the margins, more into the balance sheet and the income statement, and see how well the company is doing, their sales, their revenue growth, that sort of thing. And then if it meets an additional screener, it might go in. I do a discounted cash flow analysis, see what I'm willing to pay for the company. Then and only then will it go into my portfolio. So again, this is an initial screener to see if I'm interested in it, doing a deeper dive into the company. If not, if it doesn't meet the criteria, I just skip it and go on to the next company. So this gives me an idea of a way to get through thousands of stocks. There are thousands of stocks in the stock market. Quick look at them and see if I am interested at all. And then I go a little deeper into that. You can use this, tweak it to your investing strategy. Again, some of these might be ones that you don't like. You could replace them with revenue. You could replace them with margins. You know, your screener doesn't have to look like my screener, and make sure you're doing your own due diligence and customizing this to your investing strategy. Now back to Bristol Myers Squibb. You can check them out at www.bms.com. That's www.bms.com. That is their homepage where I pulled this information from. Over here on the right, you can see William Bristol and John Myers. They started the company back in 1887. And if you go to their homepage, you could look at their history, and it actually goes back a little bit further. It talks about some of their education, their time in the war. There's another gentleman that was part of this originally. They helped set up a lot of the criteria that pharmaceutical companies live by today. So they were early on in the American pharmaceutical company. I believe can't remember if it was William or Myers that was in the military as well. So they worked with the government to set up a lot of the criteria that these biopharmaceutical companies still live by today. At Bristol Myers Squibb, we believe in the power of science to address some of the most challenging diseases of our time. Our focus on these unmet needs come during a remarkable time when unprecedented scientific breakthroughs are advancing the treatment of disease as never before in human history. And much like the company we looked at yesterday, and Johnson & Johnson and Pfizer, this company is a biopharmaceutical company. So one of the important things you want to look at for these companies is their pipeline. Understanding what's in their current pipeline, what drugs they're making money on currently, and what's coming up, what they have in trials that hasn't been approved yet. Because what happens is, like I said yesterday in yesterday's video, at some point these companies' patents run out, and then other companies can swoop in and make cheaper drugs, knockoff drugs, typically at cheaper prices, right? So once a company's patent runs out, then it opens the door for other companies to make that same drug with the same, same patent, same materials for the same thing, and a lot of times it is cheaper. A cheaper option, right? So that's what you want to look at. You want to understand their current pipeline as well as what they have in the pipeline coming up. Now, the reason we're taking a look at them, down 0.05%, so not a big drop on the day here, but they recently did have a big drop, so that's why they're down so much. We are talking about Bristol Myers Squibb Company, ticker BMY, out of the healthcare sector. Close out the day at $41.75. They have a 52-week range as low as $39.91, as high as $66.38. They are right up against their 52-week low, and they are definitely within 15% of their 52-week low here. Market cap of 84.631 billion, a beta of 0.44. So even though you see a lot of volatility for today, they are less volatile than the overall market. They do not have a price to earnings ratio, which leads me to believe it's negative. Their EPS is negative $3.10 per share. I do not like that. I don't like whenever a PE ratio is negative either. Earnings date coming up July 26th. Forward dividend yield is $2.40. They are a quarterly payer, so divide by 4, though we will see that here at the end of the video, what their payout per share is per quarter. Very high starting dividend yield on this one. That's why a lot of people are looking at it, 5.75%. Ex-dividend date, April 4th. And it looks like they paid out May 1st. So if you were to buy them now, you would be in line for the next dividend, though you'd have to wait a couple months. 1 year target estimate, at least according to Yahoo Finance, where I pulled this information from, not affiliated with Yahoo Finance, just one of the sources I go to for information, $52.25. So they do see it not quite getting back to its 52-week high, but they do see some price appreciation as far as the stock price per share goes. Now we're going to jump over to look at dividend yield theory. To do that, we take a look at their 5-year dividend yield average, 3.28%. We compare it to its current, right, 5.75%. Over here it's called forward, 5.75%, same number. It's their current dividend. And since it is higher, that speaks to undervaluation on this one. Now, payout ratio, I like under 75% or lower. They're saying 59.84, but I'm getting a little bit of a mixed number here because whenever we jump over to stockanalysis.com and we look at their dividend history, they don't list anything. So I'm hesitant to, to trust this because I have not gotten a source that confirms that they're in the 50s. So I would do a little bit more research on their payout ratio, and when you will see whenever we look at the screener, I did not click this box. Though if you wanted to say and use Yahoo Finance's payout ratio, go ahead and click that box for yourself. But this is not one I included as one that met the metrics I'm looking for because the two sources that I looked at, only one had the payout ratio listed. Now, we're going to jump down to free cash flow. As a dividend growth investor, I want growing free cash flow because typically if a company has growing free cash flow, they will grow their dividends over time as well. They can pay down debt, they can make acquisitions, reinvest back into the company, buy back shares. So you want growing free cash flow over time. That's where the company's health is really shown. And if it's declining or negative, then you might be it might be worrisome in time to really panic if it goes bad, because again, if it's negative, then you're wondering how they're making their payout of the dividend. So going back to 2020, you can see here 13.2 billion. 2021 jump up to 15.2 billion. 2022 looks like a big drop down to 11.9. 2023 back up to 12.6. Now you can see they are repurchasing their own shares, which I like that. Big jump in 2021. A lot of pharmaceutical companies, because of the stuff we were going through, COVID back in the day, had a big jump up in 2020 and 2021. So they took advantage of that, bought back a lot of shares, had a big jump up in free cash flow. Looks like they kept on taking advantage of that into 2022. So I would say, I did not do the math. Part of this drop in free cash flow in 2022 can be accounted for in the repurchase of shares. I don't know if it accounts for all of it, but I'd say part of it can. But overall, if I'm looking at free cash flow from 2020 to 2023, it does look like it's down slightly. So another one I did not put a check there. But again, if you did the math and said that the 5.155 million repurchase minus the 1.5 million that they repurchased there made them higher in free cash flow than they were back in 2020, I'm not going to argue with you. Another one that you could potentially call a check mark if you wanted, I would back check this with another source, again, just to make sure the information is accurate and it is indeed growing free cash flow. But another one, I did not put a check here. So there's two that could potentially have a check that I did not click. You'll see that here at the end. Now, continuing on to stockanalysis.com, I always recommend more than one source so that you can make sure the information you're getting is accurate and up to date. As you saw with the price to earnings ratio not listed, that's part of the reason I do that, because again, one source might be out of date, one source might not be updated, one source might be wrong. So I recommend 2, if not 3 sources. These are 2 that I like. You pick any sources that you like. Just make sure you are not blindly following just one source, because again, it could be wrong, it could be outdated. But they have 16 stock analysts that have taken a look at this. They call it a consensus hold. Now, let me talk about the stock analysts, since I got a question about this yesterday. These are analysts' opinions, right? So they're just people like you and me who maybe do their own discounted cash flow analysis on this, do their own research, and then they're throwing out numbers. What I really look at this for is the range, right? They have a low estimate of 43 and a high estimate of 84. So that's a pretty big range. But look where it currently sits. It currently sits lower than their lowest estimate, right? So I kind of look at this as well. If the consensus of all these 16 peoples is $43 or higher, maybe it is a little undervalued right now, even though they call it a consensus hold. And if you were to go to their website, you'd be able to click on these and say how many call it a strong sell, a hold, a buy, or a strong buy out of the 16 analysts. So you'd want to do that to really give you more of a picture of where the breakdown of these 16 analysts lie. I mean, are the majority of them at $43 and calling it a sell? Or are the majority of them in the average at $59.56, which would be a 42.66% increase? Or are the majority, and it obviously not, the majority at the high at 101.2% upside? I would be willing to bet more of them are on the lower average and have it in a hold or a sell than have it as a buy or a strong buy, right? That's what I would assume, but you'd have to go to there and see. And as you can see here, price target were last updated April 26, 2024. So this is a couple months old, right? So that tells you right there that this information may be outdated. It's a couple months old. This may not still apply to this company where it currently sits at $41.75. So take these with a grain of salt and make sure you're looking at multiple sources for information so you can make sure you're getting an accurate picture. Now we're going to jump into statistics and look how well this company is reinvesting back into itself. Return on equity, I like 10% or better, negative 23%. Return on invested capital, I like 10% or better, negative 8.1%. So I do not like that at all. Now their EPS growth forecasted at 10.56 is much higher than the 5% I'm looking for, though their revenue forecast is negative 1.29. So it's really a mixed bag on this one for me. Now we're going to jump over and look at the dividend history before we wrap this one up. Quarterly payer, again, stockanalysis.com called it payout ratio NA, which a lot of times when they list that means it's above 100%. But then you had Yahoo Finance had it in the 50s. So again, I'd look for a third source so you can see if you can find the payout ratio and see if it either confirms what Yahoo Finance had or indeed is higher than 100%. Dividend growth is 5.41%. Nice dividend growth with a very nice starting dividend yield. They say 2 years of dividend growth. This is wrong. You can see here dividend growth going back to 2020, so that's at least 4 years of dividend growth. 49 cents down here in 2020, 2022 up to 54 cents, 2023 up to 57 cents, and then most recently in 2024 up to 60 cents. So that's wrong. This should be 4 years of growth. Buyback yield of 3.65% and shareholder yield of 9.4%. Very good numbers there. They do pay out in the February, May, August, November timeframe. So let's take a look at the screener here. Vested interest stock screener actually meets 5 of 8. Understand the business. Yep, that's where we started. Growing free cash flow. I clicked no, but I'm not going to argue with you if you clicked yes. You could and did the math and said that the repurchase of shares accounted for some of that decrease in free cash flow. Growing dividend, yes, at least 4 years of growing dividend. I think it's longer than that. Dividend payout ratio, I did not click this one. Again, Yahoo Finance had it in the 50s, but Stock Analysis didn't have it listed. So I'd look for a third source there. But hey, if you've gone and done more research and find out that it is under 75%, that would be another check. Check valuation based on dividend yield theory. Dividend yield theory says this one is potentially undervalued. Buy below current cost basis or within 15% of a 52-week low. Yep, it is definitely there. Return on invested capital, return on equity, that one didn't measure up. It both in the negative. Earnings per share growth was at 10%, so it's above the 5% I'm looking for. We didn't look at price to book. So 1, 2, 3, 4, 5, it would be on my watch list. Could potentially be 7 if those. But this one, with the numbers being so skewed the way they were, if you are interested in this company, you really want to get into the books. Look at their balance sheet, look at their income statement, and make sure you understand their pipeline. I believe this company also recently did some purchases of other companies, so acquisitions of some other firms that were making drugs that are in a pipeline. So that may account for their ROIC and their ROE being negative. A lot of times when a company does a big purchase like that or buys out another company, that puts their return on invested capital and return on equity in the negative because they haven't received any or seen any returns on that investment yet. So again, much more research needs to be done on a company like this, but it would be one that would jump over to my watch list. Now for me, I'm not adding it to my watch list even though it meets 5 of 8 because I am a little heavy in healthcare right now and I'm just not looking to add to that sector. I have Pfizer, Johnson & Johnson, and CVS, so I would prefer to just add to those positions because they are below my cost basis and continue to bring down my cost basis in those existing positions than to add another one. But if you don't have anything in your portfolio in the healthcare sector, this might be one to look at. Again, according to the screener, it does meet 5 of 8. So that is it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And thank you, Jacob, for the suggestion. So again, if you have a company like Bristol Myers that you would like me to cover in the Stock Pick of the Day series, drop it down below. Let me know what you think of the videos. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and money. Should never invest any amount of confidence losing. Always do your own research. Invest based on your situation, circumstances, and select the criteria, or seek the advice of a certified financial advisor.